Why haven't we changed the way that we think about money? Because Wall Street and the banks don't want us to think about efficiency, long-term and short-term. They want to focus on something in the future, give us this carrot, and keep us on the treadmill. Have a service or a product that provides value. If we can do that, money's never an issue. Like that big picture when I'm thinking like, this would change the game for people. Here's Money 101, and again, this is really important to me before we talk about my book because I want to lay the fundamental groundwork of what we're headed towards. So Money 101, you have cash flow, and money only goes two places. It's either spent or it's saved. And I actually want to just break this down a little bit. So you have money, and can we all agree that cash flow is king? Think of cash flow as the blood that makes your personal economy go. If you could be a billionaire on paper, but if you don't have money to buy food, you're not wealthy, okay? So cash flow is king. When you have cash flow coming in, your money can only do two things. It's either consumed, I'll just say it's gone. This could be taxes, this could be kids, this could be coffee, this could be debt, this could be insurance, this could be, you name it. This could be all your bad habits right here, you know? But one thing that I'm really passionate about is once you lose $1, you don't just lose that dollar, but you lose what that dollar could have earned you the rest of your life. Let me say that again. When you have $1 today, a lot of people disrespect money all the time because they think that dollar's only worth $1. That dollar's worth a lot more than $1 because if you steward it and grow it well, or whatever you want to call it, this dollar could be worth $50 in the future. But we don't think about that because we disrespect money all the time. So people consume, and so and just to make this simple, if your cash flow is 100 and you're consuming 95, that means you're saving 5. I'm just making up numbers right now. And now our saving strategies need to be focused on in the future. This is like retirement 101. Our saving strategies have to somehow allow us to stop working someday so that we can replace our cash flow from this to pay for our lifestyle. But with inflation, it literally feels like we're walking the wrong way up an escalator. And so this is a lot of people want to overcomplicate debt and overcomplicate financial planning, but at the end of the day, it's really simple. You have cash flow, it either is consumed or it's saved, and our money that's saved and invested and controlled needs to work for us so that someday we may not need to work, but our money could work at such a level that it can maintain what we're currently spending. That's retirement planning 101. People like to complicate it by portfolio stuff. All that stuff falls under the strategy, and we're gonna get into that. But big picture, cash flow is king. If anyone tells you that cash flow doesn't matter, or compounding is more important than cash flow, run, because cash flow is the king of your life. And we need to get cash flow to start working and flowing for us, not against us. All right, so three core things that we can move the needle in our own life. Number one, income. If someone comes to me and they're not making a lot of money, I can talk about tax strategies. I can talk about saving strategies. But at the end of the day, if you're not making a ton of money, one of the things that I will say as a brother is let's figure out a way to make more money. For many of you in this room, we need to figure out how to make $10,000, $15,000, $20,000 more. That would be the best needle mover in your life. Some of us overspend our money. Some of us have a spending problem. Some of us have a tax problem. Some of us are making good money, but we just seem to be like a bucket with a bunch of holes. We can't hold on to money. And I've talked to people that are paying 45, 50% in taxes when it's all said and done. So they don't feel like they're spending a ton of money, but tons of money are leaving them. And what do we know? Once you lose $1, you don't just lose that dollar, but you lose what that dollar could have earned you the rest of your life. And then the third way is growth. A lot of people are getting crushed when it comes to their strategy. Number one, we're not saving enough money, but the money that we are saving, we're not being intentional with it. We're putting it into some account. We're putting it into a bank or Wall Street, and we're like, oh, you're gonna care about our money more than we do. And so when I look at the money problems, I can give you all the stats, but at the end of the day, it comes down to people. How much money are you making? What are you spending? What is your money doing for you? Those are the three things. And then when we work with people or when you get the opportunity to talk to people, those are the three areas that you can talk to them about. Jeff Bezos said in his latest letter, this was a week ago, he said, in his last letter as the chairman and CEO, he said a statement that I thought was super profound. He said, create more than you can consume. So what's the solution? It's not what you think. I'm not going to sell my book right here, okay? What's the solution? It comes down to two things. And if you take notes on anything, you want to take notes on this. The solution comes down to, number one, the ability to provide value. What is the definition of value? It's a material or monetary worth of something. For instance, One of my favorite examples is if someone has food and you're hungry, you're gonna exchange money for that food. One of the reasons why Amazon and Jeff Bezos is one of the wealthiest people is Amazon is a convenient thing, and we probably spent money on Amazon. So there's that exchange. Wealth really comes down to your ability to be valuable. Everyone in this room has made money either working for someone, created business, real estate, everything. When money transfers, it comes down to a value proposition. Money, I heard it once said that money is essentially an IOU because you provided value to me, and so I'm gonna give you an IOU that's getting less and less valuable as it goes, and that's wealth 101. And then what's interesting is if we want to be wealthy, we have to understand the second phase is leverage. Leverage is not maybe what you think. A lot of times when we think of leverage, we just think of like bad debt. But the definition of leverage is to use maximum advantage. So think about it. If you want to become wealthy, I put them together because I'm not that creative. It's like value leveraging. Okay, value leveraging, create value and create maximum value for people, and you're going to become wealthy. So step number one is have a service or a product that provides value. If we can do that, money's never an issue, because we go back to Jeff Bezos, create more than you consume, game over. And then the second step is leverage the value creation. Is this making sense? Because like at big picture, when I'm thinking like this would change the game for people. Create value, learn to leverage that value. That is the 1-2 punch. I don't care what business you're in. This is the advice that I would do in coaching people that were in business. So let me talk about my book for just 1 second. The and asset is a strategy using a special type of life insurance concept. And it's taking life insurance and saying, we don't really care about the insurance aspect. We care about all the things that it can do. The reason I started the way that I did is I want to propose to you that I believe that the and asset can be potentially the best place for you to save, create value for your savings, and leverage that savings for other value creation. That is the context. It's not a get rich quick thing. It's not a this is going to solve all your problems. But I'm telling you, if we understand some of the problems, we understand the power of value, and we understand the power of leverage, I really believe that the and asset has a place for a majority of people in the United States today that can make a tremendous difference in their life. Let me tell you a little bit about my story. So I grew up in Wisconsin before I was enlightened about this whole warmth deal. My story didn't start out with this like fanciness, okay? Let me tell you this. My first job, I gutted chickens. So I literally processed chickens and I got paid $1 per chicken. One of my 16th birthday, someone gave me a book on option trading, the stock market, and it was fascinating to me. I started reading about how money could multiply, and I was thinking, like, our money could work for us, which was just this unbelievable thing that just blew my mind. And so what ended up happening was I was like, I'm probably not gonna work at the chicken farm the rest of my life, so what am I gonna do? And so I started working with people, and I talked to a guy, his name was Dick Judy, and he had connections, and he picked up his phone and said, young man, I'm gonna get you a job at a bank. You need experience. And so at 17 years old, I walked into Community First Bank and I became a teller, and I made a commitment that I was gonna do everything that I could. I was gonna do everything that I could to learn everything about money, create value, and so that I could show up powerfully in the marketplace. You have to understand, at 17, I had to sit on a pillow to drive a car. I also have, reading is extremely difficult for me. So you might see me now like, oh, I'm 25 years old, all these things. At 17 years old, I was wondering if I was even gonna get through college. I didn't have much confidence, but I was given a shot. And at the bank, I just soaked everything up. And what was crazy, this is what I looked at 19, by the way. At 19 years old, I took over a bank's investment department. I had an opportunity to work there, and at 18 years old, I got Caleb Williams' investment assistant. And I thought I was ruling the world kind of deal. I was like, this is amazing. And then the guy that ran the bank took another job. And at 19 years old, I became one of the youngest people in the country to step into the corner office, the second largest office at Community First Bank I had, with my bank cell phone, bank computer, going to college. And I just stepped into a big responsibility. On one hand, I was super thrilled. I'm like, this is incredible. JG, who is like a second father to me, who took over the bank when he was 28, and he ran the bank as a CEO, he said, Caleb, people don't care how much you know until they know how much you care. As cliche as it is, it's true. If you truly care, you will find better ways for people. And so I made a simple mission that day, and my mission still hangs on my wall to this day. It's to help people see and reach their highest potential. If you ask me, Caleb, what motivates you? Why am I here in Dallas? Why do I do what I do? It's because God has designed us, has created us for potential, and most people aren't living up to it. And I'm not gonna say that money is a solution. I'm just gonna say if we can get our money thing figured out, it might help us focus on our marriages, on our families, on our businesses, on ministry. And so I just saw people with high potential that didn't see that in themselves. And I'm like, if I could move meter in their life as it relates to money, everything changes. And so on one hand, being 19, I thought I was arrived. But if you can imagine the 10 minutes of horror people feel, like it was the worst. Like people would come in to the bank for their annual review. I would come up and I would say, hey, like, come on in. And they would think I was the assistant. So they would come in and then I would shut the door and you could literally see the panic on their face. And then I would sit down and just be very calculated, don't say much, because the more I talked back in the day, the less I became credible. And I just learned to ask good questions. I realized that I didn't have to be the smartest person in the world. I just needed to go back to if I know what's really important to them and I actually deliver, I don't think they care how old I am. And I'm telling you, I don't know who's in this room, regardless if you care about money or not, if you help solve problems, if you help people get results that they told you they want, it doesn't matter what you look like, how old you are, how young you are, it's a game changer. And so I just want you to know that that's when I started getting blown away with money. Like I was just like, people do not have their crap together. We've been taught to take all the risk. You guys know the definition of risk? The definition of risk is increase your chance of loss.
Yeah.
Like look it up, it's kind of crazy. So only in America, it's like increase your chance of loss and you'll be wealthy, all right? We're taught to postpone our tax. What does that mean? That literally means taxes are gonna be lower in the future, so don't pay now, kick the can down the road and see what happens. No one tells you that, but that's what we're doing. We get penalized for touching our money. Like I literally at the bank saw business owners that had businesses put their money in accounts that they can't touch and then go beg for a loan because they needed money. We're also taught to give up total control of our money. They don't say that. They don't like sign over control, but if you actually read the contracts, we don't have a lot of control over what's going on. But the biggest problem, you remember when I talked about value? The biggest problem is that people, and I made up this word by the way, people are devaluing themselves and how they're thinking about money and their time and about where their money is. And so I just had this fundamental belief that you are your greatest asset. Like everybody in this room, you have wealth or you don't have wealth, and the number one person responsible for that is you. Like human beings are one of the most incredible things ever created. We have the ability to create value, think, love, like it's so amazing. And yet so many people are living their life like they're not their greatest asset. We are the number one derivative to make everything in our life possible. And so I committed to find a better way. Like I was naive. The best thing that ever happened to me was like I wasn't getting mentored by just an average person that was gonna teach me the average way to think about money. And so I knew that there's gotta be a better way. And so I sought out and just eventually discovered that the banks, corporations, and ultra wealthy are doing the exact opposite. Instead of listening to what people say, watch what they do. If someone's saying, do this, how do they make money? How are the wealthy making money? How are banks making money? How is Wall Street themselves making money? They have an unfair advantage, and it's true. And so for those of you that are not in the industry, this slide means nothing to you. But like I literally became friends with some of the greatest thought leaders in our space. Some of the people, like Nelson's not even alive right now. He wrote a book called Becoming Your Own Banker. I could sum it up in two seconds. It's take control like the bank, because banking is the most profitable business in the world. Instead of transferring control over to them, learn to become your bank in your own life, because it's all about control. Kim Butler, and she understands cash flow. Tom Wheelwright knows a thing or two about taxes. Todd Langford runs a company called Truth Concepts. Don Blanton is another thought leader and calculator builder, and Russ Morgan. And Russ, this is actually a funny story. I invited myself over to his house. I just was like, hey, if I get to Birmingham, will you let me stay? Because I didn't have any money. And so I just want you guys to know that this is a special slide for me, because I'm only here because of the generosity of people that went before me and poured into me. And so what ended up happening was at 21, I had this brilliant idea that I was gonna leave the bank and start a company to share with people this. And when people heard that, they're like, you've got to be out of your mind. I graduated college a year early, which is by the grace of God. And I remember sitting at the bank, I had it set. I was in a corner office. No one was gonna say, oh, Caleb's slacking, running the bank's investment department. I was sitting in my office, I was looking at the mission statement that said, to help people see and reach their highest potential. And I realized, you guys, that I was lying to myself, because I knew that there was a better way to get this message out. And so what I ended up doing is I'm saying, I refuse to live life with regret. And so I left. And you have to realize being 21 years old and starting a financial practice, like you're lucky if you get an internship. And so there was a lot of people that were not happy with me. They're like, you don't wear a suit, you don't wear glasses, you don't have gray hair, you have never been kicked in the mouth. You've all these things. They're right. But we went off this mission of like, there's got to be a better way. And so Greg, Dan, and then Julie got more internship credits than I want to admit from working with our company early on. And we just went out and started BetterWealth with this whole idea that there's got to be a better way. You want to talk about not good positioning? We're in the basement of a tanning studio and Papa John's right here, okay? So it's like not winning any flexing wars right now. I'm like, yeah, come to my office in the basement of Hawaiian tanning. But here's the deal. One of the best things that I did was I took a step back and said, you know what? I'm just gonna start documenting some of the things I'm learning. Because I may be crazy here, but I think what I'm learning is gonna change the game for people. And so being dyslexic, I spoke the book, you guys. Found someone that believed in me that would help me put 2 sentences together. And it was one of the most painful processes, but to this day, I'm so grateful. The book is an example of value leveraging. My hope is that there's some value in that book, and by printing it, there's leverage. Because more than one person can read that. That's just an example of the principle. Podcast. I was like, I don't know all this stuff, but I'll start a podcast and invite people. And I'm telling you, my whole career was built on pity. They just came on my podcast, but then what happened? I created a platform, they shared their knowledge, and like nobody listened to it. And like literally it was so good that I didn't know how to read analytics. My mom listened to the first episode. Clearly no one did after, okay? So I started speaking and momentum started to happen. Here's the big thing here's my big epiphany is, and again, I shared the slide before, compounding and control. I could summarize all of money, the growth strategy, into 2 things. Compounding, what's the definition of compounding? Delaying gratification to have your money grow for a someday good thing. It's time value of money. $1 today is worth way more than $1. Control is this amazing thing, and I started learning that the wealthy people actually cared way more about control. Banks make their money from control. Wall Street makes their money off control. Jeff Bezos didn't compound his way to being a billionaire. He controlled and made moves. So I had like this dilemma. I was like, compounding, no one's really getting true compounding. No one's getting true control. Why is this the case? That's what I learned on this journey. And so I realized that we also are being lied to. Wall Street is saying that we need to choose between one or the other. And I realized that if you could have both, you will win. So don't let anyone say you need to choose between controlling your money but putting it in a savings account and earning nothing, or compounding your money but giving up control. Like I realized that was a lie that I believed for a big portion of my life. And so let's look at compounding real quick. Albert Einstein actually never said this, but he's misquoted for saying this, and so I'm like, I'll just keep the lie going kind of deal. But compound interest is the 8th wonder of the world, and he who understands it, earns it. He who doesn't pays it. The reality is simple. Majority of people don't understand the power of compounding. So what is compounding? Compounding, you need 3 things. You need some type of an amount. You need something to compound. 100% of 0 is 0. Okay, so you need something, and then you need to earn some type of interest rate. This is the benefit that transfers to us for delaying touching the money. And then over time, and time is where everything gets amazing. Time is where the exponential curve kicks in. So what was really cool is when we were writing the book, we were like, okay, a lot of people are literally compounding their money, and then brilliant people are saying, take that money out. So you kill the exponential curve that happens in compound interest, and we think about it, we're taught in school to do this. Compound your money because compounding is the best thing in the world. Most people delay compounding, they don't fund it properly, and then, you hit retirement, take that money out. Well, I thought compounding was this amazing thing. Why would I take it out? That's just the way that it's done. So how many of you have heard the penny example? Okay, this is interesting. Someone comes to you and says, and I'm gonna throw a twist in here, by the way, okay? Someone comes to Grace, okay, and says, I can double a penny for 30 days, or I can give you $1 million. Which one would you choose? You're gonna double the penny. Okay, we'll see if that's a good idea. So penny, and it just keeps going, and day 10, you're kind of sweating. You're like, $5. Subway, it costs more than $5 right now. Or is there still $5 subs? Okay, with tax, you're right at a Subway sandwich, okay? But then at day 28, you're over $1 million, and this is $1 million worth of pennies, if you guys wondered. Day 30, you have 5.3 million, okay? Now, most stories stop there. 5 million plus, so you made the right decision, maybe. But you should ask more questions. You should ask, is that true 1% compounding each year? Or are you gonna charge fees, taxes, and other things? We have to be real that there are a lot of reasons why we're not compounding our money. There's a difference between an average rates of return and actual rates of return. And I'm telling you, majority of people aren't getting a fraction of what they think they're getting because averages can lie to us. So whether it's losses, taxes, fees, not enough time, there's a lot of problems. So let's go back to the penny example. Let's just say I charge you a 2% fee, management fee. No big deal, right? Well, your $5.3 million gets cut to under $3 million. Guys, a 2% fee. What if we skip 3 days? Meaning we're not gonna lose any money, but we're just gonna have 3 0 days. 3 days of not doubling. This represents you not losing money in the market, but you not gaining anything in the market. I would take the $1 million there. What if you had to pay a 15% tax on just the growth? Just the growth, capital gains. Yeah. Does any of this happen in a bubble, you guys? Or is it possible that all three could happen? And so the question is, it's not you were right, but we have to ask, is there other things to the equation? Because if I charged you a fee, if I charged a 15% tax, and we didn't double your money 3 times in the 30 days, you now have 51,000 versus 5 million. What this teaches is we have to be ultra skeptical of what we're being taught, and average rates of return lie to us. I have this example in my book. You could have 100% return. So if you have $100, we're gonna do this. You have $100, and let's say you earn 100%. Now your $100 goes down to 200, or up to 200. Then you give your money to Mike, and he loses 50%. It's like, no, that's not good. So now your $200 goes back down to 100. Well, your average rate of return is 25%. Take 100 minus 50, divide by 2. The actual rate of return is 0. We're not including any fees here. This is an extreme example, but average rates lie because here's another principle. Every time you lose $1, you don't just lose that dollar, but you lose the earning potential, the control potential that dollar could earn you the rest of your life. Warren Buffett is obsessed with never lose money, never lose money. And so it's interesting how I could tote a 25% average, but the actual bottom line is 0. That's, again, extreme example, but we're being lied to a lot when we look at averages. Oh, this thing averaged this percent. So we need to get true compounding, and real quick, true compounding needs to happen without losses, without taxes, and without fees. Good things happen when you can dial those 3 things in. Second powerful force. And if I had to choose one, I would choose control all day long, okay? Warren Buffett's really interesting. What is Warren Buffett usually known for? He's like the father of compounding. You think he just compounded his money, putting it into the S&P? No, he's actually a cutthroat at controlling capital, buying companies. He's honestly, if Warren's buying your company and you're middle tier management, you should be afraid for your job. Because he's smart and he realizes, oh, there's a lot of money that's not being well spent. And through control, he takes a company that's worth X and makes it X, Y, and Z. That's how he has money. I just listened to an interview that he gave, and he was talking about just like wiring $8 billion to a company for a transaction. That's control. And so we go back to how much control do we have? Are we able to show up powerfully right now with the control that we have? Remember, we are our greatest asset. So the question I really want you to think about is, what is the ROI, return on investment? What is the return on investment to investing in yourself? And by the way, some of you need to be honest and say, not very much. Some of you need to say, like, it could be a game changer. I don't know. But this is the question that really comes down when how important is control? It comes down to your ability to use it. The example I use in my book, we talk about Phil Mickelson and golfing. What is the ROI of a golf club? Well, for me, it's not very much. So time, money, and a lot of golf balls no longer being found, right? For Phil Mickelson, it's millions of dollars, not just playing golf, but that golf club allows him to do speaking gigs, commercials, sponsorships. It's millions of dollars. How is the golf club the problem, or is it how we use it? Is control the problem, or is it how we use it? Okay, so these are we're gonna whip through these. I could talk all day long, so I'm sorry. So I hope this is entertaining. But 12 characteristics to a perfect asset. I'm gonna have Chris email you guys the slides, so we're gonna whip through these. But what I'm about to go through is 12 characteristics that we need to think of when we're making an investment or asset decision. Everyone wants us to focus on a metric called rate of return, and rate of return is important. You'll find that on the list, but it's not everything. So here are the 12. Number 1, safety. How valuable is safety to you? Well, if you're retiring tomorrow, it's probably a little bit more valuable than someone that's just getting started. So safety, how important is that? Easily accessible. How liquid is my money? Competitive rate of return, how important is that for us? Leverageable. This one's a big one. Do you have the ability to leverage your money and allow it to continue to grow? Guarantees, is that important? No percentage-based fees. free of regulation, no contribution limits, creditor protection, deductible contributions. How important is that? Tax-free growth, tax-free use. Is taxes going up or down in the future? I don't know. Everyone has different opinions. Everyone values this list differently. It would not be smart for me to say, well, this is the most important, and this is, because then I'm saying, like, your life clearly doesn't matter. I'm just going to talk down to you. But I'm telling you, out of all the things that I could think of, this is a list, and depending on what your goals are, you should pick from the list and say, I really value easy access to money because I want control. But you could put these into two camps, control and compounding. So how does your retirement plan hold up? Sorry for those of you that are colorblind. I apologize, all right? There's red and green, and if you look at a 401k, safety, you're not going to invest your money in a 401k for safety. But let's be honest, I'm going to check the box that it competitively grows over your lifetime. If there's creditor protection, you get a deduction, which we've been told is a really good thing. And then it will grow without paying taxes. So 401k, and with the match, like there's benefits to a 401k. Roth IRA, what's the difference between a Roth and a 401k? A Roth is just a different type of wrapper. You hope that it's going to get competitive rate of return. The difference is you don't get a deduction today, but your money grows without paying taxes, and you don't have to, and then you can take that money out in the future. I'm not a tax professional, don't sue me, but if everything is done right, you can take that out tax-free in the future. Well, if taxes are going to go up, a Roth is maybe it depends. If you're in the highest tax bracket and you're going to drop down to the lowest, this might be more favorable. Roth, if we believe taxes are going to be higher in the future, might be more favorable. And so these benefits help us measure where we should put our money. I was with a friend of mine who's like into investing, and he said, Caleb, you always talk about opportunity cost. Opportunity cost is when you make a certain decision, there's consequences to that decision. But he's like, let's call it hostage cost. And here's what I mean, is if you had a house, and that house you could put $100,000 in, you work out a deal with other people, and you could profit $100,000. So you put $100,000 in, you sell for $200,000, you get $100,000 profit. The problem is, this actually happened to him. The problem is, this deal came across his desk, and he didn't have the access to the money. He had the money, but he couldn't access it because he would get penalized and they wouldn't let him have it. So he literally was like, what is the cost of not controlling 100K? It literally cost him $100,000. This would be an example of loss of control. So then what's the solution? A savings account. A savings account is saying, okay, what we're going to do is we're going to forego competitive rate of return, but we value safety and liquidity of our money. And yes, there's guarantees, and we're not really getting fees, potential of where you put your money. And we can put as much money in, but we're not getting any tax benefits. And we don't really care about the growth. We care about the access to money so that when a real estate deal comes, we can tap into that. So you understand that, again, you go back down to these benefits, you can start measuring by what people value where they put their money. What is the most profitable business in the world? Who said banking? I know some of you guys did. Okay, banking. Well, what can we learn from banks? I've come up with 5 things, and it's in my book. 5 things that we can learn from banks, and we don't have to say banks are evil. We can use it in ourselves. And this is Nelson Nash wrote the book, Becoming Your Own Banker, and he said learning to control your financial environment is the most profitable thing that you can do. Okay, so Bank of America. Bank of America, we gave them in deposits $86 billion. They paid us $1.9 billion of interest, which is amazing. They made $44 billion. Who wants to be in the banking business? So 5 principles of banking. Number 1, banks are institutions that want money to flow to them. Think about it. Usually they waive any fees that they were going to pay you for direct deposit. Why? Because it's systematically. Why do you think Wall Street and 401ks and other places want us to get our money before we see it? They understand the power of flow. Cash flow. By the way, they're smart. Cash flow, consistent cash flow coming in. Number 2, leverage. Anyone remember the definition of leverage? That's right, maximize. They're paying us pennies on our deposits, taking our money, leveraging it out to other people and charging them 3-4%. We might think, oh, that's the spread of maybe 2 or 3%. No, that's hundreds of percent, because their investment's not the money they're giving our money. Their investment is what they're paying us on interest. They're masters at using leverage, and good for them. Liquidity. You go to the banks when you have an opportunity. When I was at the bank, I saw business owners come to the banks. Why? Because banks have all the money. The golden rule, those who have the gold make the rules. Collateral. Banks make a ton of money, they use leverage, and oh, by the way, we have to put up the house. We have to put up our car. Why? Because if we don't pay, they're gonna take it back, because they're not gonna take any risk. Do you guys realize how smart banks are? And then velocity. They don't just do that once, they flip money multiple times. It's not something magical. These are 5 things that the banking institution does. If you think about it, I was working at a community bank. We had like 25 employees, 3 branches. We had 25 employees, 3 branches. Really, we paid a lot in software. What did we do to make money? We literally just took other people's money and marked it up. We just were institutions that controlled money better than individuals did. And we supported quite a few people from that. It was a micro example of the power of banking. So if Albert Einstein's gonna make up a quote, I'm gonna also be snarky and say, well, if the 8th one in the world is compounding, the 9th one in the world is control. And I really want that to sink in, because no one's having this conversation around money, because they're not incentivized to have this conversation about money. So here's my dilemma, being this idealistic 21-year-old learning all this stuff. And I was like, okay, I feel like there's a tug of war here. On one hand, I'm 19 years old, 20 years old, 21 years old, and I could compound my money for the next 40, 50 years in a Roth IRA, other things, and I would be a millionaire 3, 4, 5 times over. But I also knew I was young. I wanted to start a business. I wanted to get into real estate. I said I wanted to start a business helping people with money. So you understand my dilemma? I had 2 good things. It was like a very first world problem. It's like I could compound my money or control it, but I can't do both. And if we don't understand the struggle that some of our clients have, I think we're gonna miss opportunities. Because we're talking about benefits that they may or may not care about, but what are they lying in bed? This was a dilemma that I had because I wanted to do the best thing. And so the light bulb moment happened for me when I realized that I was asking the wrong questions and that we can have both instead of an either or. I'm not that creative, by the way. The and came out of this pure epiphany that we can have both. And so the question is, what if you don't have to choose anymore between future and now, compounding and control? And so again, the and asset has not been something that I came up with. It's been used for over 100 years. And if you look at Walt Disney, he actually used the and asset to make Disney World a reality when they came under hard times. And you look at Ray Kroc, he used his and asset to help him fund McDonald's. And you look at presidents, both on the right and the left, use the and asset. They don't call it the and asset, but that's what it is. You look at majority of Fortune 500 companies use what's called COLI, corporate-owned life insurance. Why? You'll find out. You look at banks. Over 3,800 banks in the US alone have what's called bank-owned life insurance. Their tier 1 safest capital is put into life insurance. You look at some of these banks. Bank of America, $22 billion of their money is in the and asset, a special type of and asset for banks. So when I talk about life insurance, you have to understand I get either 2 responses usually, okay? Number 1, it's like, all right, where's the exits? Let's get out of here. Or you get someone that's overzealous and just being like, you are a horrible human being, you're trying to scam everybody. So usually two reactions, no pressure, by the way. And so, first of all, I think it's really important to understand that this is not what your family's selling you. It's not what a Northwestern Mutual intern learns. This is not what your parents own, and this is not something that you see on TV. Okay, so this is not like a typical life insurance, and it's important because I grew up in the money space, and I was anti life insurance. I mean, Ryan and I talk about this, like you don't learn about wealth and being like, I'm gonna put my money in life insurance. It's just not money 101. So there were some things that I had to understand that were different to what we teach. And so this is something that's also really important. A lot of people don't have a fundamental understanding of how this stuff works. There's three things going on when we think about life insurance at the most basic form. You have the person. This could be the person paying the premiums. This is the person that's the insured. This is the person that gets the life insurance. They enter into a contract with the insurance company. Okay, so three parties here. You have a person, insured, payer. They create a contract with the insurance company. We need to work with the right insurance company. We need to work with an insurance company that has our best interests in mind. In fact, just like there are credit unions and we get a benefit, there are insurance companies that allow us to be owners by having a contract with them. So when they become profitable, we get some of those profits. Warren Buffett loves to buy insurance companies. Why? Because they can be profitable. If we create a contract, let's create a contract with the company that pays us the profits of the company. Then the contract is something that's really technical because you can design in the contract how it's designed, how much cash you get, when you can get it, how it compounds. There's so many benefits as it relates to the contract. Majority of people, when people bring up Dave Ramsey and all these people, 100%. If typical life insurance with a typical company, horrible thing. Run, it's not gonna serve you. But if it's with the right company with favorable contract, this potentially can serve you. And remember, going back to your results, it either does it or doesn't. And so this is, when I learned this, I was like, okay, this is interesting. And when we talk about a contract, everyone is in the business of trying to pay the least amount of money for life insurance. Because it's like, why would you overpay for life insurance? So it's like, if we had $1 million of, like, let's say, life insurance and we could pay $1,000, who do you think determines the $1,000? It's insurance companies. They're competing. They're like, I'm not going to give you free life insurance because then if you die, like, bad things could happen. Like, we are transferring that risk. They have a unilateral contract agreement that they have to pay. And so the insurance companies determine the minimum. Who do you think determines the maximum amount of money that you can pay for a life insurance policy per death benefit? But yeah, someone said the government. Why in the world does the government care about life insurance? By the way, if you're ever working with a CPA or a tax person, ask them this. Whenever the government limits something, what does that usually mean? There's a benefit there. It's just interesting. You got to look at incentives. And so here's the epiphany, is instead of playing the game of minimizing, looking at this like an expense, because if this is an expense, we want to pay as little as possible. But if it's an asset, what if we paid as much as possible and we got the least amount of insurance as possible? You won't hear a lot of people talking about this because the way you do this is you reduce your commissions, you reduce what you get paid on setting stuff up like this, because a lot of money is in the base insurance. The base insurance premium is what gives you the commission. But it's like, wow, no, most people aren't thinking like, let me put as much money in and get the least amount of base death benefit as possible. But when we do that, we get our money to do multiple things for us. I'm not a great drawer, but I like to pretend. And it's like, you show me you give me $1 and give it 4 jobs rather than 1, that can be amazing. When set up and overfunded properly, life insurance allows your money to grow for the rest of your life without losses, without fees, without paying taxes if it's set up and utilized properly. That alone can be valuable. But if it's just that, you could compare it to any other investment. Even if you had to pay taxes in this investment, if it grew, outperformed it, bam, you're better off having that. But the other thing is the use component. You get to utilize that money while it grows. I'll walk you through how that works. Now I'm giving you 2 jobs to your $1 rather than just 1. But then if we understand how life insurance works in retirement, overfunded life insurance, it's amazing. Now we're potentially giving your $1 3 jobs to your 1. And the other big thing is that same decision, that same flowing that $1 allows you to protect your money and yourself and your family and your estate. What's the value of that? It depends. But now we're giving $1 4 jobs instead of 1. Again, it's not about it. It's not about this being better than real estate, this being better than business, this being better than crypto, this being better than the stock market. This is a whole different conversation because if you can use and control your money, it's not an or conversation. Are you guys understanding? It's not an or anymore, it's an and. And that for me, you guys, was like, I understand. Because for the longest time I was running because I thought it competed with everything else. And so again, if you look at this, as it relates to like how does it stack up when set up and used properly, and it has to be set up and used properly. The reason why you guys in the room here is like I'm here for a reason because I believe in the mission, and there are a lot of people that have used my book and had the wrong message. But when set up and used properly, you get a lot of benefits. The only benefit that you don't get in a typical design is you don't get to deduct your premiums. So it's not like a 401k, but there are so many benefits when set up and used properly. And again, it's again pretty remarkable. And the "and" is so important, you guys, because it's no longer a match on when the "and" unlocks everything. Okay, so biggest question I get when I present is, Caleb, how can your money be growing while you use it? Did any of you guys have that question? Like, how does that actually work? This is how it works. There's three types of people. When you go buy something, we'll just use a car for example. If I'm going to buy a $10,000 car, I could go into debt. That means I don't have any money. I'm literally going to go into debt. That means my debt is greater than my assets, and I'm going to spend the next couple of years paying that back. The Bible has a lot to say about this, and it's also like I am literally enslaved to the institution. I'm consuming, and I have a negative net worth. So I'm paying interest, and we have a really negative view of paying interest. Then there's what I've learned is saving money. Instead of going into debt, I'm going to do what Dave Ramsey says, and I'm going to save my money. I'm going to delay gratification. And then when I save enough money, I'm going to pay cash for the car. Go back down to zero. What's interesting to me is this is what I did for my first car. And if I had to choose between one or the other, I think this is a more smart way to do it. But the problem is I disrespected compounding, and in a way I financed. Because of all the money that I'm no longer able to earn, I literally disrespected the value of my money. I disrespected it. My $10,000 would have been worth over $100,000 over my lifetime, but the $10,000 that I spent on my Ford Fusion that I no longer drive, by the way, is no longer working for me ever again. So what's interesting is we either lose interest or we pay interest. What's the third way? The third way is to have your money doing something productive, but maintaining control of your money. So this is, again, not a get-rich-quick deal. But if you can have your money grow for the rest of your life, what is the value of that? And then, what is the value of being able to utilize a policy loan, or I call it in my book, control cost, controlled compounding? What is the value of being able to access money? And yes, there's some interest associated with that, but you're not disrespecting the value of what your money could be over your lifetime. And so this is an example. This is what I would say in the book is the most efficient way to use and grow your money. It's not the free way. There's no such thing as a free lunch. Remember, if we go back, you're either losing interest or you're paying interest. There's no way around that. There's no free way to do that because of opportunity cost. So this is my humble opinion of the best way to control capital with also still having it grow for the rest of your life. This is using collateral, and I wish we could go into more detail. Chris knows how passionate I get about this, but just trust me, there's other things that you guys can learn about how this works, but this is what's happening when you're putting your money, it's growing for the rest of your life, and you can have access to that. So it's kind of like the difference between using a credit card and a debit card. You can still make poor decisions, but if I have the money, I'm gonna use a credit card and get the points. Again, credit cards can be horrible because you can use them wrong, but if you use right for something that you're already gonna purchase, it's more efficient than maybe paying cash. That's exactly how I think of this. This is not an investment. It's a more efficient way to save and utilize capital. Let's go back to the real estate example, okay? Let's say you have this house and you have $100,000 in this and asset. And let's say over 18 months, you're like the world's worst real estate flipper on the planet of this earth, okay? You're gonna take 18 months, put money in, and then you're gonna flip it, but you're gonna make $100,000 worth of profit. So it's gonna be good in the end, okay? You're gonna double your money. Okay, so if your money is in your life insurance, remember, it's not leaving, it's compounding the rest of your life. And so let's just say 4%, it could be 3%, it doesn't matter at this point. But 4% over 10 years is $148,000, not life-changing. 30 years, $324,000, and 60 years, it's over $1 million. So let me ask you a question. If you took that $100,000 and put it into the real estate, you have the real estate, do we all agree with that? But your $100,000, assuming it could earn 4%, well, you just gave up $1 million over your lifetime. Again, if I had to choose between one or the other, I would choose real estate because 4%, doubling my money over 18 months is greater than 4%. But taking that money out, there's an opportunity cost. Do you guys get that? So then, just because I want to make the point, what if on the $100,000, I borrowed against it, so I allowed my money to grow, and I paid 5%. Why would I do that? Why would I pay 5% to earn 4%? That doesn't make any sense. Well, over 18 months, I would have to pay $7,772 of interest. In my book, I call this the control cost. I'm paying almost $8,000 to control capital, but my money's continuing to grow for the rest of my life. And so then I go to the deal, and I am paying this interest to make $100,000 worth of profit, and my money continues to grow. Again, this is how it works. It's not a free lunch. If you had cash, you would go put your money and but your money would no longer be continuing to grow. And as you'll see, there's a lot of benefits to having money in life insurance. There's a lot of other benefits. But this is how it works. Not a magic bullet, but powerful, because now your dollar, you have a paper contract that's allowing you to do two things. Now, the real estate could be a disaster. Okay, so again, we can't throw our brains out with this, but it allows the velocity of our dollars to do more than one job. So we look at retirement. Again, I don't have a ton of time to go through this. I had the opportunity, and I'm friends with the guy that actually founded the 401k. I kept my mouth shut when I was talking. Ted is amazing, and he made really good points when it comes to 401k, and he said, overall, Caleb, 401k has been a positive thing, because if it wasn't for the 401k, no one would have any money. But he will be the first to say 401k fees, taxes, we need to understand pension funds, because it's a disaster. Another one of my friends talks about tax diversification in the future. No one's talking about taxes. Everyone's talking about risk. What are taxes going to be? We talked about using life insurance. Dr. Wade Fowle is one of the leading researchers when it comes to the 4% rule and the different retirement strategies. And guess what he uses as part of his strategy? He talks about a volatility buffer to utilize in the market. He also talks about something called a pension maximization strategy. Both utilize life insurance. Life insurance is not the core asset, but he talks in his research that life insurance unlocks your portfolio, unlocks pensions, and allows you to get more because of how it's structured. Jason Sanger runs a company called Wealth Building Cornerstones, does a lot of research on pension funds, and pretty much says, back in the day when we all had pensions, by the way, anyone that has a pension is sitting pretty good. What is a pension? Pension uses they use investments and life insurance. And with actuarial science, with life insurance and annuities and investment, that's how they can pay you for the rest of your life. And yet we're told that life insurance is a bad investment. It's not an investment, period. Barry Dykes, I know some of you guys have read Pirates of Manhattan. He does research on what corporations are doing, what banks are doing, how wealthy people are creating income streams, actuarial science. Guess what? Life insurance is a part of that strategy as well. So I'm learning all these things, and I'm going, oh my goodness, we need to be able to articulate the value of life insurance long in the future. I'm working on a movie right now, and there's a lot of people that are having conversations about what we call infinite banking or utilizing life insurance as an and asset. Very few people are translating the power of life insurance at retirement. And here's my thesis. If you can understand the power of your retirement value of money, and you also understand the power of control, and you don't have to choose between one or the other, that is what the message is going to be about this movie and documentary. I'm literally going to say some people should not bank with their life insurance. That would be a disaster. Let's be honest. That would be a disaster. But if all someone did was shift some of their money and had more cash flow in retirement, is that a bad deal? And on top of the control. So this again, I'm going to potentially get crushed when I go, because people have very big opinions. But at the end of the day, what's crazy to me is there's so many smart people, and I feel like I'm like the glue that's bringing everyone together in this message. Real quick, death benefit, why is that important? I showed a picture early on starting BetterWealth. Greg is like a second father to me. He's amazing. He was one of my first clients, helped start BetterWealth, and he actually died about 2.5 years ago of cancer. And I firsthand saw the power of life insurance. Number one, I did an episode on this. Greg made a ton of money using his life insurance policy to buy cows. And he'd buy cows. What's it called? Someone told me this earlier. It's like, yeah, cow flipping. You take a cow, you raise it, you flip it, and you make money. And guess where he came up with the money to do that? Insurance. What's crazy is he had all these grand plans of building BetterWealth with me and got diagnosed with stage 4 liver cancer. And a lot of people say, Caleb, you're an old soul. I've witnessed one of my best friends dying, and one of the things that if he was here, it would all be about intentional living, all about family, like all the way that we treat the people that we love the most. He taught me how to die well, but he also showed me the power of having life insurance because his family wasn't left with anything. His family was left with a death benefit. And if it wasn't for this, they would have been left with nothing. So what is the value of that? Again, this is what everyone talks about when it comes to life insurance. They don't talk about all the other things, but I don't want to skip over something that's so valuable. Every time a client gets an and asset, they are insuring and protecting their family and the things that they care about. And we can't skip over that because that's super valuable. So why haven't we heard of this? We haven't heard of this because, number one, look at incentives. Wall Street and the banks, their money's not with them, by the way. If we do this right, the money's literally taken out of their control and out of their system. So they're smart. They don't want us to know about this. 401ks. We've been taught that 401ks again, Wall Street 2.0. I have nothing against 401ks. The person that discovered the 401k is my friend. But we look at this as this magic bullet that's like, oh, this is gonna solve all the problems. And so it's not even on our radar. A lot of you have never heard of this 2 years ago. Tax advantages. If everyone did this, the government potentially would change rules. Now, every time there's been a tax rule change, everyone's been grandfathered in. But if everyone was paying tax now on the seed and growing their money tax-free, that's not a good position to be in for the government. Luckily, very few people know about this. Life insurance is super misunderstood. The most watched video on my YouTube channel is calling Dave Ramsey out for his bad information about life insurance. I'm gonna have more videos on that, by the way. And by the way, I have a ton of respect for Dave Ramsey. Like, I know that's not popular. Chris is probably dying in the background. Yeah, dying in the background. By the way, you gotta look at who he's talking to. He's talking to people that are massively in debt, and most people, when it comes to life insurance, are screwing people because they're not setting it up properly. I'm empathetic to that. But then you have a big platform, you say certain things, and then everything gets a bad rap about it. So there's a lot of smart people that I have respect for that hate on this stuff because of the whole marketing. There's a lot of bad stuff. Overfunding. You will find most people in the life insurance space. Financial advisors won't do this or don't know about this because, again, you do this, you cut your commission in 1/6 of what you would get. You're doing the right thing for the client, but at the end of the day, you're not getting a ton of money. And then there's also work. A lot of people, like, financial advisors are lazy, man. Like, they are. And then, I mean, you just got to find the right person. So there's a lot of reasons this doesn't work. And these are the reasons why you haven't heard. Like, what are the negative things about this? You have to qualify health-wise. Not everyone in this room would qualify. So this is not like everyone get in a line and get this. Some people can't. And then there's not like, you put money into life insurance, just like a 401k, you don't have all access to all your money immediately. So some people need all their money always. This is not for them. So this is not like, again, a silver bullet. This is a foundational asset that you guys have I've laid out that some of the advantages, and it goes back to this idea of value leveraging. I'm talking about life insurance, but I'm thinking about it, I'm looking through the lens of value creation, the value of giving your dollar multiple jobs, and the literal word leverage using to the maximum. I believe and asset, when set up and used properly, is a foundational asset that can change people's lives, not because it's the most amazing thing in the world, but because of what it allows for us to do. I think of it as a key. Life insurance is not the it, but it is the thing that helps you unlock things in the market, unlocks business, maybe unlocks certain things. And as a result, the result of that is a total game changer. So I will leave you with this. I am on a mission. When I found out about this and when I funded a policy for myself, I have multiple policies, and when I lived through what Greg went through, I was like I want to see 1 million people in the next, I'm behind by the way, but five years get life insurance, because if this happens, our whole life, our whole the whole country, the world will get changed. Like, we wouldn't need all these social programs if people actually got this at the foundation, because yes, they're stewarding their money and they have opportunities and all these things. Wall Street and the banks would be in trouble, right? But also, this would also protect the next generation. And I could do a whole talk on generational planning, doing 3 generations, and each generation will get wealthier and wealthier, guaranteed. And so overall, guys, it's an honor to be here, and it's humbling. It's actually fun. Jason is helping me with the movie, and he's got a powerful story, and he literally got to walk in the trenches with Nelson Nash and some other people that have been sharing this message, and I'm just one of the blessed ones that got to learn about this before him passing and become friends with someone that's going to help me tell a story and help people take back control. Because again, cash flow is king. Everything that we go back to is cash flow, but why is cash flow important? It's going back to the metric of intentional living. Intentional living is the metric. If we don't get clear on that, none of this matters. Because you can compound your money and control it, but if you're not fulfilled in life, I'm sorry, there's no silver bullet that's going to solve that. But this at the foundation of someone that's clear of where they want to go. Efficiency pretty much says that a phone, everyone has a cell phone. I bet everyone here has a smartphone. Why? Because it's efficient. It's our camera, it's our light, it's I can call people, believe it or not, on here. We can text, we can do emails. It's my GPS. Yes, it might have cost $1,000, but think about how many things I'm able to do with this. Cars, how many people own a car? Why? Because you know where you wanted to go, and it's a lot more efficient than walking. Why haven't we changed the way that we think about money? Because Wall Street and the banks don't want us to think about efficiency, long-term and short-term. They want to focus on something in the future, give us this carrot, and keep us on the treadmill. So with that, guys, thank you so much, and I appreciate you guys all laughing at my jokes. So. Yep. Hey, if you want to learn more about the AND asset, check out all the resources, including a 61-page handbook, in the vault below.